More financial functions, beginning with rate and NPER. Provided you define the other parameters of a loan, the rate function will return the rate that's being charged for the loan. Same thing is true for the NPER, the number of periods. Provided you know some of the other parameters for a loan, it'll return the number of periods that it'll take to pay off a given loan at a given rate for a given payment. The cum payment and the cum principal, provided you know some of the other parameters for a loan, will respectively return the cumulative amount of interest that's been incurred on a loan given a certain number of payments, or the amount of principal that's been paid back on a loan given a certain number of payments. The NPV, the net present value function, provides a present value for a series of cash flows at a given discount rate, and the IRR, internal rate of return, XIRR, and modified internal rate of return respectively, the rate of return for a series of cash flows, assuming the cash flows are reinvested at that same rate of return. The XIRR will return the rate of return given non-periodic cash flows. And the MIRR, the modified internal rate of return, lets you define the reinvestment rate and the cost of capital used in the investment. So I have a schedule that I've used before, except at this time I've used the payment function in cell K7 to determine or give me the payment for a loan that has an amount that's borrowed given a certain number of months at a certain rate. And I can change any one of those three values and the payment function will recalculate and my schedule will rebuild itself based on those new values. So the rate function. The rate function will return the interest rate for a period of an annuity, whether it's an amount that you're paying on a loan or whether it's an amount that you're receiving from an annuity, a lump sum that is earning interest along the way that you're drawing funds out of. We're going to use this schedule to validate the rate and the NPER, number of period functions. So beginning with the rate function, RATE tab, the number of periods I'm displaying in months. That's perfect because that's what I want, comma, the payment is the payment per month. The present value, comma, is the amount of money that we're borrowing. The future value we're going to leave at 0. The type, comma, is when the payment or the cash flow takes place, at the beginning of the month or the end of the month. The default is the end of the period. And then the last argument, optional argument, is Excel wants us to guess. This just provides Excel with a starting point to iterate from so that it can determine the rate of interest that's being charged on a given loan. I'm not going to guess. I'm going to let Excel figure it out. Entering, I get what looks like 1%, but it really isn't 1%. I just need to reformat this and move the decimal place a little bit. It's 0.833, probably 3333, and so on, percent. And I formatted cell E14 as well because I want to take the monthly percent times 12 to get the annual percent. And that annual percent equals the rate that's being charged on this loan. When I change the rate being charged on the loan to a different amount, say 15%, control enter, the rate function returns 15%. So the rate function can figure out how much interest is being charged given an amount of money that's borrowed and a payment that's determined over a given period of time. The NPER function, the number of period function, equal NP tab, requires a rate, which is that value divided by 12 to get us a monthly rate, the payment, which is a monthly payment of that amount, the present value is the amount of money that we borrowed, and the odd man out at this point is the number of months, which is the exact thing that the NPER function is going to calculate for us and return, which is 24. So using these two functions, you can actually determine if you've got some financial arrangement with some company and they're not being completely upfront about the amount of interest that they're charging you, you can calculate what that interest actually is and or how long it's going to take you to pay back the loan. Like when you're paying a minimum credit card payment, for instance, and you don't have an amortization schedule, which I believe at this point they actually provide you with. If you make the minimum payment, they'll tell you how long it's going to take you to pay off that balance. But if they don't, you can use these functions to determine for yourself. So the next two functions, the cum I payment and the cum principal, returns the amount of interest or the principal that's been paid for a payment stream for a given loan, given a certain range defined of the periodic payments. So the cum I payment, tabbing that into the cell, picking up the rate for the year divided by 12 to give us the rate for each of the payment periods, which is the number of periods, which is 24 for 2 years. The present value is the amount of money that we're borrowing. The start period, I'll just pick a number. Start period 5, end period 12. And the type, once again, refers to when the payment takes place, which in this case, as far as the calculations go, in my schedule is at the end of the period. Entering, I have an amount of interest incurred that accumulates to $2,325.68 for the payments between the 5th period and the 12th period. And looking down at the status bar, which gives me the sum of the selected cells, I see that exact value. The cum principal, or cum prince, will do the exact same thing, tab, only it of course will give us the principal that's been paid on the number of payments that we're going to choose in the payment stream. The present value again is 100,000. The start period, let's pick period 15, and end period 20, type again is 0, enter. We get $25,515.30, and the payments that we selected from this payment stream begins at 15 and ends at 20, and the status bar shows the same number as the value that's in B20, except the value in B20 has just been rounded. $25,515.27, which is the exact same value. So in order to determine the interest that you've incurred on the entire loan, just include all of the payments in the payment stream, beginning with 1 in this case and going to 24, which includes the last payment, enter. So the entire amount of interest paid on its loan is $5,291.34 rounding, and selecting all the interest expense that's been calculated in the schedule and summing it, we have the same value that's shown as the sum in the status bar. The next function we're going to talk about is the NPV, the net present value function. The net present value, before we get to the function, let's talk about what the net present value is. We've actually already touched on this concept using the present value function. The present value function is really the net present value of an even stream of cash flows, which is what I have in my schedule. I have an even stream of 5 cash flows occurring 1 year out, 2 years out, 3 years, 4 years, 5 years out at $100 per year. So I can use the present value function to determine what the value of that cash flow is today, discounted at 10%. I also can calculate what each one of those values discounted to today is independent of the other values. And the way you do that is to divide the cash flow by 1 plus the discount rate, which is 10, and then take the exponent of that value determined by the number of years. So $100 discounted for 1 year is $90.91 rounding. So I should be able to take that value and multiply it times 1.1 to get $100. $100 discounted for 2 years is $82.64. So I again should be able to take that value times 1.1, control enter, and I get a familiar figure, which I can take that and multiply it times 1.1 and get my $100. So doing this one more time, I can take this value, which is the calculated present value of $100 I receive 3 years from now, discounted at 10%, times 1.1, control enter, control C, and copy it twice over, and again, I'm able to get back to my $100. So $100 discounted over 1 year is $90.91, 2 years is $82.64, 3 years is $75.13. So I've used this calculation to sum up what the present value is of all those cash flows. And again, they're even cash flows. It's $100 a year, of course, which the present value function is capable of handling. What the present value function is not capable of handling is odd cash flows. So if I make the amount of money that I'm receiving in year 3 200, Control Enter, the present value function didn't change at all, but my calculated present value of the cash flow that I'm receiving in year 3 changed, and so did the sum of all of those independent cash flows that are being discounted to the current year. And the net present value function returned the exact same amount as my manual calculations returned. So the net present value function generally is used to discount a series of cash flows that you anticipate making from an investment that begins in year 0. So this series of cash flows represents the present value, again discounted at 10%, of $100 received a year from now, and $100 received 2 years from now, 200 received 3 years from now, and so on. If this investment cost me more than $454.21, I'm not going to make any money. But if it costs me less, and let's say it cost me $250, I'm going to put that in cell I-14 as a negative number, Control Enter, because that's a cash flow out, and the other values are positive because it's money coming back to me. So if I take that amount and then add the net present value of the cash flows, I get the present value of that investment. It's the net present value of the returns minus what it costs me to generate those returns. So the net present value function will take a rate and discount a series of cash flows occurring over a number of periods to give you that present value so that you can determine whether an investment is warranted or not. Okay, we've got a lot going on here. In order to make sense of this, it'll be helpful to understand the NPV, or the net present value concept, if not including the function itself. We're going to talk about the internal rate of return, the X internal rate of return, and the modified internal rate of return. But once you understand the internal rate of return, the other versions of it are just a slight tweak on the concept. So beginning in the first block of information, I have the years listed beginning at year 0, where there's a $1,000 investment made. It's a cash outflow, it's negative. And from that $1,000 investment comes a cash flow that's forecasted to be $200 in the first year, $250 in the second year, $300 in the third year, and so on, $350 and $500. So that the total amount of cash that's involved in these cash flows is $600. I've just summed all of those values together to get a return of $600. I've got $1,000 coming out, I've got $1,600 coming in. The net sum total of all of those values is $600. That's a non-discounted amount, obviously, and the $500 I'm receiving 5 years from now is not worth the same amount 5 years from now as it is today. So we're going to want to discount those cash flows. When we discount those cash flows, we have a discount rate that's applied. In this case, I've used the internal rate of return as the discount rate, so that when I'm determining what the present value of $200 received a year from now is, I'm going to divide the $200 by 1 plus the discount rate, which is the value in cell H27, and then take the exponent of the number of years. So before we get to the internal rate of return function quite yet, an important thing to understand that when I use the internal rate of return as a discount rate, the value in total, which is $1,000 of all those discounted amounts, exactly equals the amount invested in the first place. So that the internal rate of return has calculated a discount rate such that the net present value of those cash flows equals the investment in the first place, or in other words, the net present value of the entire cash flows taken into account is 0. So I've taken the value in G19, which is an outflow of $1,000, and taken the net present value of all of the cash flows and used the discount rate that the internal rate of return provided to get a net present value of 0. And since we use the internal rate of return and we haven't built one yet, we're going to build or rebuild this internal rate of return function. Just keep in mind that what we're doing is determining a discount rate such that the net present value of all the cash flows equals 0. So equal IRR tab, the values can be found in this series of cells. And the guess is an optional argument that gives Excel a starting point to iterate to the correct value. I'm going to leave that blank, Control Enter, and there's my discount rate that's returned back to us, 15.32%. So if we take these calculated numbers and blow them through what's called a loan table, it might help to understand what's going on with these cash flows a little better. The loan table begins at year one with $1,000, which is the investment. So the loan table is going to calculate the return on the investment, which is the income, and the return of the investment, which is the return of the principal or the investment itself. So we begin with $1,000. The cash flow for the first year is $200. The income that we're making on the investment is the $1,000 times the rate of return. We had the internal rate of return calculate the rate of return. We're applying that rate to the investment, which is $1,000, giving us a return for the first year of $153.24. And since we got a return of $153.24, the additional cash that we received over and above that, which was $46.76, was a return of the invested funds themselves. Because when you make an investment, you're getting back the return on the investment and or a return of the principal amount that's invested. Since we got $46.76 returned to us that was part of the principal, our principal amount was reduced to $953.24, which is $1,000 minus the return of the principal for the first year. The second year, we got a positive $250 cash flow. The income that we earned is the internal rate of return rate, 15.32%, on the invested capital that exists at the beginning of year two, which is $953.24, and the additional funds that we received over and above the income was a return of the principal, which is $103.93, which gets subtracted from the amount that we have in the game, the amount that we have invested, and on it goes. So that at the end of this time period, we have $1,600 that's returned, which is $1,000 of our original investment plus $600 worth of income. And there's the $600 worth of income, because it's the total of all of those income calculations. And there's the $1,000 of the return principal that's the sum total of all those calculations. So recapping just one more time, the internal rate of return function returns a value that's a discount rate that, when applied to the cash flows, makes the net present value of those cash flows equal 0 when you include the original investment that was made, which was in this case $1,000. So we have the internal rate of return. We also have the XIRR, the X internal rate of return, which will return the internal rate of return for a non-regular series of cash flows, ones that don't happen with a fixed period every year, every month. So I've built a little schedule of cash flows. It's actually the same values that are taking place sort of randomly beginning January 1st, 2010. So I'm going to use the XIRR, tab that into the cell. The values are here, comma. The dates, of course, are here. And I'm not going to guess. I'm going to let Excel figure it out. Close the parentheses, Control Enter. And the XIRR is 25%, which intuitively sort of makes sense that it's higher because the cash flows are taking place over a period of time that spans 3 years, 4 months, and 12 days. Whereas when we calculated internal rate of return, the cash flow took place over a period of 5 years. Once again, that is the value when used as a discount rate to discount those cash flows, for which the net present value of all of those cash flows will be 0. So that's the XIRR. The MER, the modified internal rate of return, calculates a return on the investment a bit differently. I'm going to go back over here and input a mirror function equal MIR tab. The values are the series of cash flows, including the investment itself. The finance rate is what it cost us to borrow that $1,000 and make the investment. For companies, this could be a weighted average cost of capital. It could be the interest expense paid on the loan minus the tax benefit. But let's say we've got a pretty favorable financing rate, and it's 5%, comma, and the reinvestment rate is the rate of return that we receive when we reinvest the cash flows. And let's further presume that we are in a company that reinvests capital with projects that have a forecasted internal rate of return of no less than 10%. So the proceeds or the cash flow that we are going to generate from this investment have a cost, it's the finance rate, and the cash we're receiving are going to be reinvested into the company, and let's say the reinvestment rate is 10%. Closing the parentheses, enter, and the mirror has calculated a 13% return on these cash flows. The mirror is probably a more accurate way to calculate a return on a series of cash flows because the internal rate of return assumes that the proceeds are reinvested at that rate, at the 15.32%. If you've got a highly productive or highly profitable project, that's probably not likely. And the other thing that the mirror takes into account that the internal rate of return doesn't is the cost of capital. So I should be able to go back in here and change some of the values of these arguments. And let's say the cost of capital is 0 and the reinvestment rate equals the internal rate of return, enter. I'm going to go back up and add a couple of decimal places. We get the result that you might expect, and that is we get the internal rate of return value. So the internal rate of return assumes that the cost of capital is 0, the financing rate is 0, and as I said, it assumes that the proceeds are reinvested at the internal rate of return rate. And adjusting the argument values for the mirror, the modified internal rate of return, bears that out. So we looked at a few financial functions. We looked at the rate and the NPER, the number period function, which given the other elements of a loan, will return to you respectively the rate of interest that's charged on the loan if you don't have that bit of information and you have the loan payment amount, the amount that was borrowed, and the term of the loan, the number of years or number of months. And the NPER will return the term of the loan if you have the other elements identified for the loan. The cum I payment and cum principal will return respectively the interest that was paid over a series of payments for a loan or the principal that was paid for a series of payments for a loan. The NPV, net present value, will return the net present value of a series of cash flows using a discount rate. The internal rate of return calculates the rate of return on a series of cash flows such that when you apply that rate as a discount rate, the net present value of those cash flows is 0. The XIRR calculates the rate of return for a non-regular series of cash flows, and the MIR, the modified internal rate of return, calculates the rate of return for a series of cash flows taking into account 1, the financing rate for the funds used in the investment, and 2, the reinvestment rate for the cash flows generated from the investment.